love the channel and find it useful in becoming a happy retiree. Subscribe today. Good morning. Welcome back to Money Matters. As we decode this debate, where do we head from here? Heavyweight analysts duking it out over where they think the economy is headed. I'm going to weigh in, of course, as well. So if you're just tuning in, we just played a clip of two highly regarded Wall Street guys. They're fighting over which part of the economic cycle they think we're in. If you really listen to the argument, they actually do agree on the secular outlook versus the cyclical outlook. And this is always a little confusing. It might be very confusing when you use these two words. Cyclical and secular, they sound pretty similar, but they're vastly different. One is long-term, one's short-term. But linguistically, they're kind of similar. It almost makes them contronyms, like buckle, which one meaning is to fasten together, the other is to break down or break apart. Like sanction, one meaning is to grant approval, the other is to condemn or penalize. Yet these two words in investing have very different connotations. So cyclical means short-term, secular long-term. And that they throw these words around, and if you don't understand exactly what they mean, it makes the whole debate super confusing. And we're going to talk exactly about this as soon as we get back from quick news, weather, traffic, more Money Matters straight ahead. Welcome back to Money Matters. All right, so we've been talking today, and I want to get to this, about this disagreement effectively with two heavy hitter Wall Street analysts. One saying, look, I think that we're close to the end of this cycle and the market has kind of seen its best days. The other says, hey, we got 11 years left to run higher. What? So it's obviously it's going to be confusing for most folks listening, because you've got two smart guy A basically saying, hey, the good ride's almost over. Smart guy B saying that the current run up has legs, room to run, and lots of runway in the next 11 years. So confusion sets in. Long term versus short term. They're talking economy, economic cycle, cyclical, secular. What do you pay attention to? So first off, if you really listen, I'm going to decode this debate right now. If you really listen to the argument, they do agree on the secular outlook versus cyclical. And again, we just talked about how it's important to understand those two words. And they're a little bit confusing. They kind of sound alike, but pretty simply, cyclical means short term, what's about to happen. So think of it soon or soonish. And secular is that's what's going to happen if you zoom out and you look at a longer period of time. Let's call cyclical 1 to 5 years. Usually. And let's call secular 5 to 20 years, usually. So notice if you listen to the clip, Mike Wilson says, I agree with the fact that I agree with the secular case. So he's saying he agrees on the long term, but from a cyclical bull case, I don't agree with that at all, is what he said. Secondly, it's the short run where they don't agree. It's really the short run where they disagree on. And quite frankly, they both have very solid arguments. I've discussed a very similar metric that the Morgan Stanley analyst talks about in regards to the economic cycle ending. One of the very best measures to understand when the economic cycle breaks and when the market starts to really go downhill is look, and Liz, I've talked about this on Money Matters many times. I look at wage inflation, which is a derivative of employment. When that gets to 4.5%, due to a tight labor market, the economic expansion almost always ends. So higher wage, and think about the progression here. By the time companies have to start raising wages because the labor market gets super tight, we go from 4% down to 3%. So virtually everybody that has a job or wants a job has a job. Now workers can demand more or higher wages. So those higher wages squeeze corporate profits. And then the big companies, their earnings get hit. And then they when that happens, they lay off workers to try to increase their earnings. And then the unemployment rate goes up on a broader scale. Boom, we're in recession. That's how it ends. Or that's how the cycle ends. But wage inflation. So again, I agree with that. But wage inflation, even though unemployment's really low, that's great. But wage inflation's still only about 2.5%. Nowhere near 4.5%, which is the number where things start to go badly. So we are a long way from that. The other analyst makes several points, and this is Thomas Lee, makes several important points and gives evidence of this whole the cycle being more midterm means that hey, there's time left to expand. Housing starts. We've a long way to go before we get back to normal. We averaged about 1.75 million housing starts year after year after year after year. That dropped to close to 450,000 in the depths of a recession. And then it's been climbing back ever since. And now we're at about 1.2 million. So we have we're still, call it a half a million shy run rate on housing before we even get back to normal. So housing is a long way to go. Inflation, I just talked about, wage inflation, still a long way to go. And remember too, tax reform. Tax reform is just getting started. We should do a whole show on the benefits of tax reform that still haven't even really begun. So we're not going to know the answer to this debate until 2019, because we won't know until the end of next year who was right over this next 2-year period. And in Lee's long-term view, of course, we're not going to know for another 11 years. So who knows even what the world's going to look like in 2029? In the meantime, the only thing we can and we should focus on is the long term. That's what matters. The secular part of the argument, that's really what matters. Not what's going to happen in the next 6 months or a year. As smart as these guys are, they have no idea. Last year, I talked about an article series I did called Head West. It referenced the European explorers. Remember, this was not a precise group of gentlemen. They ended up all over North America, South America, Central America, but the direction they went worked. The journey paid off, and all because their general direction over the long run was right. Hey, we're going to head that way. We're going west. No matter if you went directly across, or you went slightly northwest, you went directly west, you went southwest. Either way, you ended up on this side of in the northern in North America, or you hit Central America, or you hit somewhere closer to South America. Their direction was right. And the bottom line here, when you hear these arguments, they get into the weeds and they start to make you question, well, what should I be doing in my 401k? Maybe I should step back from this market. I still think the general direction for markets and for this U.S. economy is, if you look at a chart, northeast. That's the general direction for GDP, for equity markets, is northeast, at least as far as I'm concerned. That means the chart goes from the lower left to the upper right. That's the direction you want to see it. And if that's the case, then forget about this short-term argument. Forget about the spit-spat arguments that we see on TV. And we see these all the time. This one just happened to really catch my attention because it was two real heavyweights. They almost had the exact same job. And they had this really poignant disagreement on live television, which you don't necessarily see two heavyweights do that every day. So you've got to ignore a lot of what you see on television, even if they're these heavyweights. They, nor you, nor I know what's going to happen the next week or the next month or the next year. We just don't know. But we do have a good sense of the bigger, larger journey. That's what matters. And that direction as far as I'm concerned, is continued expansion for a very long time. For a very long time. Here in the US and many economies around the world. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.